What is going on, everybody? And in this video, we are going over a technical analysis, my entries and exits for current stocks that I am watching. Also, I do provide a weekly analysis on upcoming events, upcoming earnings to get you prepared for the week. And I also do provide daily pulses on the market at Hemi137 on X. You can also check me out there. But before we get started, go ahead and drop a like and let's dive into some technical analysis for the week. Now, as you can see, the SPX in itself, even these zones, these typical zones here, you can see they're very apparent. But as you've noticed, as we've gotten essentially closer to the election, it is becoming very, very choppy. Despite it continuing to grind up, it is not looking pretty. Again, with everything going on, we need the elections. A lot of people are essentially big institutions are waiting for the election to kind of dictate where we go from this point. And as you can see, we've gone absolutely parabolic, which is absurd to think that the market is ripped up like this. That's not manipulated at all, but but yeah. So this is what is interesting. Essentially, we've paused right here, and like typical cycle fashion, you do have a bull run typically on that because it's kind of solidifies the fact that things are starting to turn. But the problem being is there's a reason why you are essentially pausing. And if we are in a golden economy, why would we need a pause, especially with there's a lot of concern about inflation? So what you're seeing is a very see ascending wedge. Now, what you may ask, well, what is an ascending wedge? An ascending wedge is typically you have this sharp movement up, which is continuing to get worse and tighter as you are getting closer. This is why we are waiting for the election, because this is going to play out. And typically, what happens is you retrace 75% of this move. You know, you can have a descending wedge or an ascending wedge. This one you'll retrace down to about 75%. So you're looking around a 47, so almost 1,000 point drop potentially here is what you're looking at. Now, with all that being said, what is scary is that you are seeing a very, very close similarity to the 2008 financial crisis. And essentially, Lehman Brothers was essentially the tipping point that kind of uh, pop the whole thing, even though there were so many problems. And now we're looking kind of at the same thing currently going on. But what you're seeing is that the automobile industry could be that one to pop it. It could be the commercial industry. Commercial loans are absolutely blowing up as well. And then you have the automobile industry, which is starting to blow up. It just took so long because of the massive supply we had because of the pandemic. The demand came back for that, so it took a while for that to play out. But being said, there was tons of underlying issues and a massive, massive amount of debt. I think everybody owes about 4 grand a month on debt, which is absurd. But yeah, this is what's currently going on. So we're waiting for this to play out. And like I said, as stated, we're only 2 weeks away from the election. So I got more deep into my analysis video. I think you should really check that out. It gives a lot more understanding of the current economic environment and not applying risk because you are essentially getting at a choke point to where this is going to correct. Now, again, on average, something we talk about is 42% correction. That'll roughly put us around that 3,300 mark. If we do correct, it could be more or less than that. Given the historical data that we currently have right now, it could be more, right? What we deal with is probabilities. And as of right now, we will just look at the 75. That there's a higher probability that we would correct that because we do have some rolling recessions. But we're looking for is a massive correction, potentially something like this back in 22 that had played out, where essentially we bottom on tech right around here. And again, we had a massive spike down. This candle was mostly on a lot of Jerome Powell. Uh, Essentially, this is what happens. They tell you one thing, and then something completely opposite happens. Like it comes out of left field. Like we didn't know it was going to happen. They know well aware what's going on. They have better insight into the economy. They know what's actually going on. And again, the Fed are very reactionary. This is why you get these massive red candles down and then massive green candles up because, oh, it's better than expected, but expectations are so low, so then you get the sell off again. Oh, so expect something similar to this playing out in the next couple months. Again, we are strictly waiting for election, and I do believe that this is, again, very parabolic. This is absurd because you can look back in history. Never have we seen something so heavily manipulated, right? It's always been pretty smooth bull run up, typically. 2008 right here, crash, bam. But it's been smooth, and we have a lot of references even down essentially to the cuts, the 50 points. If we get two 25-point basis move cuts, we would match exactly 2008. Now, the problem being, and this is something you need to keep in mind, back in 2008, when you are looking in, it was in January of 2008, we started getting emergency, essentially, meetings, and we cut, I think, like 125 basis points within a span of like 2 weeks. And then you started, that's essentially when the Lehman Brothers thing started playing out. So you had a pullback and then just massive selling over the next several months, all the way down essentially until February of 2009. That could be what you're looking at all of next year when you're seeing this, because this is essentially manipulation on top of a print right here of 40% of the money supply because of a pandemic move here. See, as you can see, the moves are a lot more volatile when you print 40% of the money supply. So even though it's been steady, slowly going up, and then you see what and why we need essentially a decompression of what's currently going on, because this is absurd. The fact the market just goes up, maybe we're starting to crash up. So for some reason, when we break above this, that would be highly concerning. We want a normal correction back down 75% to at least roughly that 4,500 mark would be ideal. So at least 1,000-point correction on the SPX would be fantastic. But again, we will see. As of right now, like I said, I typically trade on the 1 hour, so a lot of these zones look a lot better on the 1 hour. But as you can see, it's just nasty, sloppy chop over the past, like I said, couple of weeks. It hasn't been a very clear coat because the market again is waiting for something to happen with the market, and I do believe again we could potentially challenge the 6K mark. But right now, what you're seeing as well is that you are smack dab in the middle of earnings, and you're going to get a lot of really ugly earnings. We lost another bank. That should be highly concerning. And at this point, they're not going to bail out banks anymore. They're going to essentially focus their efforts on critical banks that if those banks go under, essentially the whole system would go under. So they're going to focus their money this time. Again, they're trying to win an election, so they keep the other banks propped up. So there's no bank runs during this, this final year. But we have gotten two that we're aware of. We've gotten one that essentially was in advanced talks a couple months ago that got acquired, and then we actually lost one here on Friday that was obtained by the FDIC. So now, again, expect a lot of that to start happening once the election is over. At that point, it's going to get pretty wild. So just keep that in mind. So that's what we got on SPX. Again, you're in price discovery mode. So you can't really, aside from going for the psychological numbers of the 5,900 and the 6K mark is kind of what you're looking at. I don't think the market's going to randomly push up to 6K within 2 weeks. Might have a rally towards the back half of the year just to try to do that as long as they can sustain it. But again, like I said, once they hit essentially the election, then it's fair game after that. Then there's no need to win a vote. So then they kind of loosen the belt after that point. So again, we'll see how this plays out. But again, I think psychologically, the 6K mark is kind of what you're looking at. Kind of tops out at this top range here anyway. So we'll see if that plays out or not. But again, in my opinion, I think it's still very too high to try to, unless you're doing smaller, riskier plays to the upside. I think you're really pressing your limits. Once the new year hits, there's a lot of stuff that hits in the new year. Again, Fed actions are going to be extremely important over the next 2 months, and how that play, or next 3 months, 4 months will be extremely important. If you start getting panic cuts in January, February, then that's highly concerning. And then we have our normal heavy pullback in March anyway, towards the back half of February, March, early March period is typically when you pull back pretty heavy. So that's the time when everything can start rolling over pretty heavy. So just have to be mindful of that. So let's take a look at Bitcoin. Bitcoin looks like it is attempting to break out here. We'll see if essentially this daily candle, if we can keep essentially above that 67, that 50, 68 mark over the weekend, that'd be great. Again, it's not saying you can have a fake breakout. Ultimately, you're still kind of trapped here roughly around that 73K mark. So that's the ultimate breakout you want there. This thing can break up like many times and then sink back down. So you have to be careful of that. But as of right now, could lead into the rally to the back half of the year. Again, you typically get your real true bull run after essentially not a split, but the halving. So about 6 to 7 months after the halving is when you actually have the true bull market, and that would kind of line up with what's going on with Bitcoin. That may be delayed, depending on what happens with the market. If the market starts really selling off heavy, I think Bitcoin will fall into that same category. So you do have to be very careful about that, especially because it's already high and you're challenging almost all-time highs to be buying at this point. I think you have to be very, very cautious in that tail. So that's what we got with Bitcoin. So watching those particular levels, so you're really at a critical level for this to at least stay above this wedge. But again, you get heavy resistance here at the 73. So that's really the mark you really wanted to break and get in price discovery mode is when you start getting an influx to try to hopefully push it up. So we'll see what happens here, but it has been consolidating for quite a bit. Looks like it could be a breakout, something to definitely be watching for. And then let's take a quick look at bonds. Bonds, again, holding this essentially that 94 mark. You want it to hold above this to stay above this wedge here. There's many times you can see where it falls below the wedge. Typically, that's not a good sign, but as long as it can hold that particular zone is ideal. If it breaks and can't get back over it quickly, then it's going to be highly concerning as we could start selling off the bonds. But again, the bonds won't move up highly until probably, I would say, like January. If we get 225 point basis moves, it might keep us in this range. But again, January, if we again reflect back in 2008, January of 2008, if we start getting massive cuts, 125 point cuts in a matter of 2 weeks, that would cause this thing to start skyrocketing. So that's really when you want to be started watching bonds. I've talked about bonds for a long time. It's when they start heavily applying the cuts. That's when you're going to see some really parabolic moves in this thing. And so that's what we've really been watching very closely. And again, you have a little bit of time when the Fed start announcing the cuts. So those are things you have to keep in mind, especially when they start emergency rate cutting. Something I've been highlighting over the past year is what you want to be watching. Now, Tesla's the other one. Tesla's really, this here is actually the 200 moving day average on the daily. Tesla really needs to hold this 216 mark. If it does break back below that, you do have some strong support here at the 200 mark. But if it does break below the wedge, I think it might hold because it does have earnings this week. If it does do well this week, I think we can attempt to make our way back up to the 260 mark, but it's really been held down by that. You've had some strong resistance there. You also had some really strong resistance roughly around this 312 mark. So again, with the earnings, I think Tesla can pop back in here as long as there's no massive news, which again, right now, the next 2 weeks, it's going to be very critical. And there's a lot of major news that could happen. So you have to be right now is not the time to be over leveraged. I can tell you that over the next 2 weeks, at least wait till after the election, and you might just continue to get chopped. We don't know, but as of right now, again, that's kind of the critical level. Again, this is just 200 moving average. So it's more like a speed bump, and it really needs to either bounce quickly out of here, or it's going to fall back down at least to the 200 mark, which has again been a strong support. So we'll see that, and then The support being here, the 170 is pretty strong as well. And we've continued to chop, and this is something that Tesla normally does anyway. It consolidates a lot before you have any kind of major breakout. But we're kind of seeing that. I mean, it did break this wedge. We talked about this many times before. It did break this wedge. Could be retesting for a pop. So we'll see if that is true or not. Again, Tesla has a lot of positive things going for it the next couple months. So we'll see what happens. But that's what we're looking at for Tesla. Palantir, another great use case for AI. Again, still too overextended. A lot of people are trying to pile into this thing. Just be very, very careful as of right now. Like I said, the whole market in general is very overextended. If this thing does start to sell off, again, anything, you have some really strong support. So this thing like grinds up for the most part and doesn't get these massive like gap ups until like earnings, it seems like, or massive contract announcements. Aside from that, it kind of just consolidates. So we'll see what happens. But I think it's a real bullish run will happen very shortly here in the next couple of months. But I do believe once that correction comes, this may come back down into the low 30s, maybe even 20s. But we have to see what the fear looks like in the market at that point. Again, none of this is going to be a black swan. I'm going to forewarn you right now. We've been talking about all the issues that are currently going on. Then it'll eventually play out. It's just parabolic, just like the market in itself. So that's something you need to keep in mind. But the nice thing to see is even on higher time frames, it's very distinguishable on where the zones are here. And that's what I really like about Palantir is you can see where the zones are at. So the $6 mark, I don't think that's going to happen. Even if this market corrects, I think you can correct this thing back down, maybe below 30 for a brief stint. Depending on how bad the fear is during that time. But again, this parabolic move needs to be corrected. And then we go from there. I think buying now here, when the market in general, this is why I have a general market thesis, because that can override this quickly. And it won't take this all the way back down to 6. It really depends. I mean, anything is possible, but I think the probability of that happening is pretty low at this point. So have been talking about this in this lower levels many different times, even around this level with all the consolidation and here during brief stints as well. But with that being said, let's take a look at some of these other ones. So we'll take a look at SoFi. I've been talking about SoFi for a while here. Now, SoFi, again, kind of topping out roughly here at the $10 mark. It needs to break that. If it can't break that, I can see this thing correcting back down to 7. We'll see how it is. It always has these massive run-ups and then essentially gets blocked and then crashes all the way back down to 6. So, and if we have a correction in the market, especially with any kind of financials, this is going to get hit bad. So you want some cushion here. So this is why I talk about a lot of these companies get these like massive parabolic runs, and then you get the massive bad news that happens to try to correct it and try to keep it within this massive range here. So just keep that in mind. You do see it play over and over. Again, the market is about a lot of patterns, and that's something you do see quite a bit. So we'll see if that's the case here. If it does break out here, I think you can really start getting parabolic. But again, it needs to hold above essentially that the 1050 mark, needs to break above that and hold above that. So we'll see if that's possible for the remainder of the year. Again, if we start getting a lot of bad earnings, this thing is just going to start correcting, even though it's done very well and continue to remain profitable. But it is a financial, so you got to be careful with that. And then Celsius, I've been talking a lot about this one. Going to be able to strong position in this. I do really like this for a longer investment or longer swing in this one, for a very long swing potentially. So I do believe it can reclaim the $100 mark, but we'll see what happens here. Again, consolidating in these next two, roughly from that the 39 and this 29. So you got a pretty big range here on Celsius, but I think if we do sell off even more, I think you're briefly going to touch the 20. But I think because of the massive selling that's already occurred, I think this can kind of sustain this. And like I've said, you typically what we've been seeing, you see a lot of consolidation, then you get a spike down. That's essentially institutional buy, and then it'll rip up from that point. So I think we will get one last visit down here, roughly around the 20. as we get institutional buying at that point before this thing starts pushing back up. So one I really want to be watching, but again, consolidating nicely around this range, but looking to pick up some shares on this one. Then Elf, much like that one, it's already corrected massively, but the growth of this is just crazy, crazy good. And it's kind of this range here, roughly from the 115 down to just the $87 mark. I think these are great buy zones for Elf. I think it's one of those definitely big changing companies with a growth rate and what they do. But yeah, I think again, this thing is just consolidating. There's not very many good buys, especially in this market. And I think if we do start selling off heavy, I think it can sustain roughly around that $89 mark. Because despite the bad current economic environment that we're in, they still have a tremendous growth rate in the 30s, 40s. And so with that being said, I think once everything starts to turn, this thing will start ripping up and making new highs. And so these are times you want to buy when it's already beaten down like this massively in a market like this. Like it's already corrected quite a bit. So it can still correct. It can correct even more. But the probability of that happening after a massive correction already, I think could get into some buybacks, especially because of the year over year. It's been doing so well at this point. So really looking at that one. This other one, I've been looking at this. Portillo's is another big one I'm really watching here. I'd like it to get down to this range around the $10 and just below $10. This is another very long-term swing here. I think in the overall, this would be more of a longer-term investment for the next couple of years. Restaurants, very distinguishable restaurants, your Chipotle's, your Domino's have made some incredible moves throughout history, more so than even growth stocks. And so the majority of growth stocks. So this I think could be the next potential play. So a lot of basic foods, and a lot of people really love their food, and they have, again, they're more in the Chicago area, and they're building a lot of these out in Texas as well. I believe on the West Coast, there's a bunch of them as well. Not so much on the East Coast yet, but once they start building that out, I think this one will really start doing it. So I think it has some really great growth potential. But as of right now, looks like it could have broke down, retesting some resistance here. May see it revisit the 1094 here. But like I said, if we really start selling off heavy, I think you can get it around this $8 mark. That would be ideally where you want to start going heavy in this one. Slowly starting position in this one, but really looking for some heavier buying down in this area. For that, let's take a look at some of the ones we normally look at. BA, again, we don't know why it's at $155, but it is. Right now, it's currently kind of holding the speed bump, which is roughly around the $150 mark. Heavy resistance here at the 165 mark. Looking for this potentially, if the market wants to rally, retesting this, and I think we could potentially see lower into the 123. But right now, this is more of a speed bump. We'll see if that remains to be true over the next couple of weeks. But again, you have a lot of big events coming up, so this could sway this very, very quickly, in my opinion. Again, it has a lot of bad sediment to it, so I'm surprised it's even holding out where it is. But as you can see right here, the 126 is a very solid support. So the ones that I think you're going to get major correction in are the Mag 7 when this does happen. So just keep that in mind. Same with, you start looking at JP Morgan, right? Like it had these massive rip ups. Again, this is where the meat of the bone is going to happen. If we're going to have any kind of correction, which is just getting back into price discovery mode right here. So if it breaks and holds above this 225, you start psychological. It moves about $4 a pop, so just keep that in mind. But when it sells off double that, so about 8 points. So you have to be careful with that. But nonetheless, I think this thing can correct, and I think if it does correct, it'll be back down to the 173, 76. Again, these are 23. I think we had some rolling recession, so I think that will help even when we do price in a recession. But a lot of these lows here, like the tech was 22, and then this one was last year. A lot of financials got hit pretty heavy. So we'll see what happens with that. But again, I think you can correct quite a bit on this. And again, depending on where that news comes from, maybe switching things can make a big difference. And so when you again look at tech, tech has a lot more meat on the bone, especially when you look at something like Apple, who has done absolutely horrible, yet they're still trying to break all-time highs. This is all buybacks. That's all this is a bunch of buybacks. And so just keep that in mind, because their sales are going to get weak and continue to get weak. Over the past year and a half, it's been absolutely horribly bad. And I'm expecting this earnings to be exactly the same. And buybacks are what's keeping this thing afloat. So with all that being said, again, if you've made it this far, go ahead and drop a like. And until next time, I'll see you guys later.